First off, I posted my very first TikTok to my TikTok channel, Mortgage Ninja. I'm not sure if anyone saw it today, but if you did, make a comment. Let me know what you thought. But
Hey, Sean, will you put your TikTok name in the chat
Sure.
so that everybody knows it?
Absolutely.
There's going to be a lot of great tips and tricks on his TikTok. So make sure if you have it to friend him on that. And if not, download it because I had to. So everyone else do the same.
It's one of those things that I'm like, I'm not going to get TikTok. That's for kids. And boy, was I wrong. And I think it was. And there was a bunch of kids dancing at first, but then that's definitely morphed into something that is useful for everybody. So with that being said, the TikTok that I made basically was a secret, me talking about a secret of the mortgage industry. And right now, mortgage rates are getting better. They're on the trajectory to kind of reach where they were at their lows if we continue to go that route. And I'll go over that in just a second. But essentially what the TikTok was about, the mortgage secret that I revealed is most people have no clue when refinancing that you can do any term you want. They have no clue. So let's just say you've been in your mortgage for 5 years and you've got a rate of 4.25. And you call your mortgage company, they call you, whatever it might be, and they're like, okay, we can get you down to 2.625 or 2.75. And you're like, great, let's do it. And then 90% of people, I think, automatically just do another 30-year. Well, you've already been paying interest for 5 years on that older mortgage. And if you get another 30-year, you're restarting the clock, you're restarting the marathon, and all those 5 years of interest just get thrown away and just wasted. So you can get any term you want between 10 and 30. So if you want a 22, if you want a 17, if you want a 26, whatever the term is to match whatever your existing term is left on your loan, that's what you should really focus on, so you're not restarting the marathon. The analogy is it's almost like running a marathon, and then in the 6th or 7th mile, you think, you know what, I really want that new pair of Nikes to wear that are a little bit more comfortable. And then they give them to you, and then you have to start over from the starting point again on the marathon and restart the whole thing. Like, that's foolish. So anyhow, that's what the little TikTok was all about, kind of in a little funny way of doing it. But I tried to be creative and funny and not goofy at the same time. But all right, let's just get into what's happening with mortgage interest. But I'm going to start with a stupid mortgage joke, just because that's kind of my personality. So bear with me. The joke is, I thought people would flock to my mortgage company if I offered 0% mortgages. Unfortunately, there was no interest. Oh, that's so bad. That's so bad. All right, so I'm moving on. Sorry, I do have a cheesy sense of humor, so you have to just bear with me on that. So let's share the screen and kind of show you what the markets are doing and go from there. So this is an overview right now of from last January, what the bond market has done, and then what the trends are. So we had a pretty rough start in January, and we kind of had a pretty waterfallish kind of a trajectory, so to speak, with rates. The bonds, where rates were spiking quite a bit. And down here is when the Fed started buying a lot more mortgage-backed securities to bring it back, and then they slipped off again. And this was a lot of this was because of just massive inflation that we started seeing, and really afraid of that. And then it kind of started picking up again because everyone started talking that it was transitory, meaning it's not going to last forever. It's just basically getting the supply chain back in normal health. And so we started seeing the bond market recover. And then we saw big inflation numbers that scared the markets a little bit and then recovered. And then inflation numbers hit again, then we recovered, and then inflation numbers hit again, and then we recovered. So you can see this trajectory of what the bond market is doing. It's a pretty steady, strong trajectory. If you look at just the last couple months, it's even a little bit more steep. So let's kind of go in here and show you right there. So as you can see, this trend line is a lot more aggressive since June 14th, as far as what the mortgage bonds are doing. And this is giving us a lot better pricing on mortgage rates. Remember, rates stay the same. The pricing is what changes every day. You can get any rate at any time, whenever you want. The pricing of that bond is what changes, and that's what people flock to, that 0%. So if you can see, so today to June 14th, we had 200 basis point difference in cost for that rate. Essentially what that means is a rate today costs no points. The same rate back in June cost 2 points to get. So that's how much better we are in interest rates. Now let's get a little bit more deeper into this so you can kind of see a little bit more. These Fibonacci levels, these lines right here, are these levels of resistance, are hard to break through, and they create ceilings and floors. So today we broke through 2 of them, 1, 2. So we broke through the 25-day moving average, we broke through the Fibonacci level, and we're above it now. So that is creating a new floor for us. So hopefully the trend looks like, let me open this up, that we're going to continue to see all this room up here that we had before. If we break above this, we're going to continue that trend line, and we could continue to see rates get lower. So that's an exciting piece. The reason for this is A, the economy is not as strong as we all want it to be. Inflation numbers, they are there. It's causing a slowdown on a lot of different factors. Employment numbers still aren't there. The employment numbers are coming out this week. They're expecting 900,000 new jobs to be started. That would be a huge, huge number. And if that's the case, we may see a slight reversal in this, but don't be afraid. Look at these. We've seen reversals before within the trend line. Remember, when rates get better and the bond market goes up, it's never a straight line. So you have to look at the actual trends. So we may see it slip back down, and then mortgage backs may recover again. But if those job numbers come in lower, we're going to continue to see this number increase and rates get better and better. So that's the good thing. This will spur a lot of conversation in regards to refinancing. That's why I created that TikTok on how to refinance properly, really. Never restart the clock unless you absolutely have to. If it's a cash flow thing and you really need the lowest payment possible, the only way to do that is the longest term, which is the 30-year. So that's kind of where we're at as far as interest rates. Let me show you what the actual mortgage averages are on the Mortgage News Daily website, so you can kind of see what the trend is. I think we're at 2.875. We're at 2.84 now. So they're not huge moves, but that number is going to continue to drop. The 15-year average is 2.25. It's really low. So we're in a really, really good place. So now I kind of want to get into, I'm going to take the share screen off for just a second here. If I can figure out where it went. There it is. Stop share. I'm going to jump into the, that's a good one, man. Somebody likes my humor, so thank you. Jump into the questions as we go. So FHA, I want to talk to you guys about FHA because 99.9% of the world's population thinks that if they get an FHA buyer, they're not as strong or as good as a conventional buyer. And I want to just take away a lot of the fears away from FHA, but I want to first start by just stating the obvious. A lot of times people go FHA because they may have a lower credit score or not as much money. So in today's market, I know things are going above ask, and they need that extra cash a lot of times to bridge the gap between the appraisal and sales price. So I get that. So I know that there's some pieces of the puzzle, but I want to show you some things that are really positive for FHA. First off, one of my favorite ways of using an FHA loan for a first-time home buyer is having them explore the multi-unit universe. Meaning, as young kids buy real estate, if they're really interested in creating real estate portfolios, the best thing that they could do, especially if they're in college or if they're going to get roommates, is they can buy up to a 4-unit property with only 3.5% down. And the price of those properties, the loan levels goes up for every door that you finance. So just to give you some numbers, a single unit, obviously that's a normal 368 is the FHA limit. 2-unit is you can go up to 471,000 loan amount. 3 units, 569 and change. And then the 4-unit, you can go up to 707,000 loan amounts. So also a trick with FHA, you can use the rents that you make on those other 3 units to offset the mortgage payment to help you qualify. So if you have anyone interested in FHA or a single person, or not single person, a young buyer that's looking to build their portfolio, you can look in the units with only 3.5% down. Contrast that to somebody on the conventional side. Conventional, you need always need 25% down if it's regardless of what you're doing. So if it's a primary in one door and investment on the other 3, FHA would allow that as a primary residence, and you can use the income from the other units to offset the mortgage to qualify. So it might be very simple if you have an existing property that already has rents for them to buy that, qualify as a primary residence, and have the rents pay for the whole thing for the buyer. Yes, those maximum amounts again, 368 for a single family, 471,100. So 471,100 for a 2-door or 2-unit, 569,450 for a 3-unit, and 707,700 for the 4-unit. And that's the mortgage limits. And again, as little as 3.5% down. So that's one of my favorite ways of using FHA. So don't forget about that when you're talking to first-time home buyers that are pretty savvy, that are interested in building a real estate portfolio.
Do they have to be a first-time home buyer to get that deal?
No.
Okay, good.
So the nice thing about FHA is it's a way to get in with a very low down payment. You don't have to be an FHA buyer, but you can't have multiple FHA loans in the same area. So very similar to VA, you have to be transferred in order to get a new FHA, or sell one property and reestablish to get another FHA. So keep that in mind. Another really great thing about an FHA loan is the mortgage insurance is much cheaper monthly than a conventional, and this can really help out when qualifying. If you did a side-by-side analysis of an FHA loan versus a conventional, it's actually substantially easier to qualify for an FHA loan than it is a conventional loan. There's a lot more red tape to get through on the conventional loan side in regards to underwriting than the FHA side. FHA is a lot more liberal in regards to debt to income ratios as well. They'll go 5% higher in debt to income ratios, which is a huge factor. And because if you have a 650 or 660 credit score and you're qualified, it shouldn't matter to the listing agent if the loan's already approved. It shouldn't matter what the credit score is, because an approved loan is an approved loan. You're getting to the finish line regardless. But for the buyer, conventional, you're probably looking at like a 1.4% mortgage insurance factor if you have a 660 credit score, whereas if you have a 660 credit score with FHA, it's only a 0.85%. It's almost half the cost. So there's some really good things with FHA that a lot of times the buyer may be able to go conventional, but it's a lot cheaper per month on cash flow to go the FHA route. So do not discount an FHA buyer just because they're FHA, unless, now this is important, unless the property has safety or health issues associated with it. If it's a property that's run down, that's older, has lead-based paint that's flaking, stuff like that, it's a little bit more of a challenge. If there's broken glass, if there's exposed wires, those are types of things that FHA will always point out that have to be fixed prior to closing. However, most of those things conventional will point out as well and require to be fixed prior to closing if there's broken glass. But a lot of it can be done afterwards, but it will be pointed out in the appraisal mostly. So appraisals, I want to make sure you guys know this too. On an FHA loan, the values are not scrutinized more at all. They are not scrutinized more than a conventional. The value, the way they come to value on a property is exactly the same as the conventional as far as how they use comps. So don't think that it's never going to appraise with an FHA loan, or don't think there's going to be appraisal issues unless you know that there's health and safety issues with the house. If the house was built in the 90s, nothing's wrong with it. Maybe the carpet's disgusting, but nothing's wrong with it. It needs to be painted. you're not gonna have any issues with FHA in regards to the appraisal. So I want to make sure that those rumors, so to speak, or those industry ideas of what FHA buyer looks like.
Well, that's the problem, Sean, is, yeah, I don't have a prejudice against FHA or VA, but tell that to some of these other agents, that are the listing agent. You can't get them to even consider it.
Exactly. And part of the problems with FHA that people are afraid of, and that's, I mean, if we're gonna have arguments, we need to know the other aspect of it, right? Like a good debate. They'll argue, well, what if it doesn't appraise? Is the appraisal does stick with the property for 90 days. So that is a piece of that puzzle. But if it doesn't appraise on FHA, it's not going to appraise on conventional either for the most part, because it's the same formula. So either way, they're going to have some sort of a rebuttal to be done, or some sort of a renegotiation, or they're going to have to bring in the extra money. We do understand this market, how they are, everyone's going above ask. But you are correct. And that's why I'm doing these calls. And that's why I want everyone to know, if you have an FHA buyer, do not just discount it because it's an FHA offer. Find out why it's an FHA offer, because there may be because they just have a lower credit score, but they're fully approved. They have extra cash. I've had buyers with FHA that do 20% down. And because they had a short sale or a foreclosure or a bankruptcy in a shorter period of time, FHA would allow it, where conventional needs to wait 7 years for foreclosure. FHA is only 3. So there's some really good reasons to use FHA, but we need to get to the bottom of it. That's why having the loan officer engaged in that conversation when you make an offer, if it's an FHA buyer, is incredibly important. I will reach out to that listing agent and say, listen, it is an FHA offer, but I want to talk to you a little bit more about the details regarding it. You need that conversation, because otherwise they'll come to their own conclusion in their brain about why they're going to just discount that FHA offer immediately and just wipe that off the table. They're going to create their own reason why, and it may not be accurate. So absolutely. Now, there's one here. I've run into more uncertainty about peeling paint and wood rot getting in the way of those. That is correct. If there is some wood rot or peeling paint, that still may be pointed out in a conventional loan, especially if the home's older and it has maybe lead-based paint. But those are the things you have to really take into consideration if you are making an FHA offer. And here's another thing I want to talk to you about too regarding this. If your customer can go conventional, but FHA is a better option for them, and they want to do FHA, and the property does have issues like that, have an open and honest conversation with the seller. Say, listen, I want to make a conventional offer because it's stronger in your eyes, even though that's fallacy sometimes. But they can go FHA and get a much cheaper deal. I want to make the offer on this, but I want to watch that they can go both ways. Would you have any problem if they're approved both ways of us switching to an FHA if it's a better deal once we go into contract? You can have those open conversations, and then you have that upfront, because you don't want to make anyone upset with trying to do a switcheroo once you get under contract. But if they know they can go both ways, and worst case scenario, they'll close with a conventional loan, then have that conversation. Because sometimes it's better to do an FHA loan when you're a buyer. Now, obviously, money is a huge piece of the puzzle. If they don't have extra money, a lot of people, when they see FHA, they think, oh, they're poor, they don't have any money, they have bad credit. That's not always the case. So having that conversation up front is incredibly important. All right, so hi, Sean, with FHA buyer on a property with peeling paint, can't the buyer do an FHA Reno loan? Yes. Yes, they can. The 203K is a renovation loan. Peeling paint, there's 2 versions. There's a mini FHA rehab loan or a full-blown FHA rehab loan. If it's peeling paint and there are some issues with maybe lead-based paint because of the age, then yeah, that might be an issue. Another thing to do is to just, before the appraiser goes out there, just paint it over real quick. Now, if it's really bad, you're not going to want to paint the whole house. But if it's just little areas like the fascia board or something like that, just kind of paint over will allow it, because a lot of times this is going to be pointed out by the appraiser. And if there's nothing visible, then they won't see it. Obviously, you need to be careful with that slippery slope of hiding items, but yes, you can always do a renovation loan, always. Another lender that did a spreadsheet with loan type comparisons. Do you have that? Yeah, there's actually quite a few. We can put together a spreadsheet of like the differences between FHA and conventional and get that out to you. There's quite a few on has loan to value, has credit score. Now back to credit score. There is no FICO score requirement for an FHA loan. Let me repeat that. There is no FICO score requirement on an FHA loan. So if you have an FHA buyer that's been declined because their credit score is below 620, it's
You need
that,
to buy one of these
that mortgage company's
for
fault. It's the mortgage company's rule, not FHA's. FHA does not have any written FHA FICO score requirement. So if somebody has a 545 credit score, they can still get an FHA loan. As long it's all risk-based. So they have to prove they have reserves. They have to prove they have a solid income and a good debt to income ratio. As long as they have that, it really doesn't matter the credit score. Now, if they're a train wreck on credit and they've never been able to pay anything on time, it's going to be a problem. But if they had a major issue with like a divorce that caused major trauma to their credit score 2 years ago and they're back on track, but their credit score hasn't recovered, FHA does not have a credit score requirement. It's the mortgage companies that have that overlay. So just keep that in mind. If you have anyone that's declined because of credit score on an FHA loan, that's not a true statement on what FHA allows. It may be true for their mortgage company. So just keep that in mind. Another thing on FHA, if you have debts regarding that are part of medical issues, none of those have to be paid off. If there are medical collections or medical issues on credit, it's ignored with an FHA loan. So keep that in mind. So FHA is a good loan for the right person. And I want to make sure you guys understand when you get an offer on your listing to think about your listing. And if there's any safety or health issues, that's really the only thing that you should be afraid of. And obviously, whether they're properly approved. But that goes for any conventional loan as well. If they go through my program where it's fully approved through underwriting, the only issue you should have is, do they have extra cash if the appraisal comes in low, and other health or safety issues with the listing itself. But other than that, do not be afraid of an FHA buyer. Now, we're human. We're always going to think, well, it's an FHA buyer. They may not have enough money, but ask. Have the lender say, you know what, they're doing 3.5%, but they've got extra if they need it. They have a cap of up to $10,000 to go over asking without an appraisal coming in at listing if needed. Make sure we're having those conversations. Now, there are some really good first-time home buyers out there that are missing out on opportunity because they just don't have the cash. Do not give up on them right now, because the tides are turning a little bit in the market. We're starting to see a little bit more homes on the market. It's still way below what it should be, but keep the conversations going with them. Let them know there may be more opportunities as we come forward. Rates are going back down. Don't give up. It's still better to buy than to rent. And if they're trying to find a rental, you know how difficult that is too. So keep them in communication with them so they know just to be patient. There's a lot of buyer fatigue out there, but don't let the reason for them missing out be because it's an FHA offer. Let's really communicate to the listing agent when you're making those offers as to what their strengths are. And I'll ask the listing agent, you know, what are your fears regarding this FHA buyer that maybe we can overcome? And I'll ask them, are there any safety and health issues with the house? Okay. Are you okay with the offer? Do you think that the comps support the price? And if so, okay, let's move forward. And just have that conversation. Just be open and honest conversation so that we get rid of those fears that are associated with them just pushing aside an FHA buyer. And how many of you guys knew, and you don't have to raise your hand, but unmute yourself, knew about the 4-unit with only 3.5% down investment property, primary residence type scenario? Because a lot of people don't know that.
I did not know that. I think that's awesome.
Yeah, a lot of
I
people
knew
don't.
it, but I didn't know you could offset the the mortgage payment with the rental income.
Yeah, it's really fantastic. Now, it takes somebody that's savvy that is going to want to deal with people next door paying rents and whatever it may be. But if I knew that when I was that age, I would have absolutely done that all day long. all day long. And I probably would have done it over and over again until I met my wife, because then she wouldn't want to live next door to a bunch of people. But there's no limit to how many times you can take advantage of that. If you have a property and let's just say you buy it for college and you're in Flagstaff, and then you want to rent the whole thing out and then buy another one somewhere else and relocate for work, there's ways of doing that as well. You can always refinance that out of the FHA into a conventional and remove the mortgage insurance, make it even more of a cash flow giant, and then go do it again. So there's a lot of really neat ways of doing that. Carla, yes, I'd be honored to do that. Any questions regarding FHA, or maybe some things that you've heard that really turn you away from an FHA buyer? Would love to answer those questions.
Hey, Sean, I've got a question about it. I had a client that tried to do a multi-unit with as little money down, and his lender kept pushing him to a conventional loan and said he had to put 15% down minimum.
Interesting.
Does that make any sense to you? Because I thought that you could do an FHA loan, but the lender kept telling me that I was mistaken.
Well, I'll be nice to the lender. Maybe he didn't read the guidelines properly. Maybe he doesn't know. There are a few things that are a little bit more expensive on the 4-unit. There is an FHA funding fee that every FHA loan has. So if they have the money to put more down, then I would let them know what their options are, but I wouldn't discount the FHA option. Now, conventional does go a lot higher on how much they could buy on the conventional side. So that might have been a reason to try to push the price up a little bit on that 4-unit, but that'd be the only reason that I can really think of. And so that would be the only reason I could think of.
Could it be a mortgage company's overlays, their own overlays, or no?
It could be. It could be. Every single mortgage company out there has their own risk analysis that they provide on what loans they can originate. So some mortgage companies out there, banks are notorious for it. They're just a given. They decline more loans than they approve sometimes. But they have really strict overlays. So you have to make sure you're dealing with a lender that is a direct lender with Fannie, Freddie, Ginnie, and all the major institutions, that there's no middleman and that there's zero overlays. That way, you know, your buyers have the most power possible at their fingertips. The last thing you want to do is have a customer go to a preferred lender of yours that has overlays and they say, no, we can't help them, when in reality, that's a paycheck that was lost. So that you have to really be careful of when you choose your referral partners. I can't count how many times I've gotten a call from somebody saying, hey, they were declined. I don't know why. They sound like they're good buyers. Can you have a look at this? And then I look at it and it's like they have a 615 credit score on an FHA loan, and they're more than qualified, or they're jumbo with a 680 credit score and that bank has a requirement of 720. So you have to make sure that your referral partners have the most ammunition behind them so that we can really do well for your buyers. But yeah, that might be the case. They might just have overlays. It's hard to say. All right, per city, per climate, can't do Williams and Flag, but could do Sedona. How far? Okay, so the rule with FHA, with getting another FHA loan, it has to be a relocation of some sort. So if you're in Williams and you're trying to buy a house in Flag and you're like 15 to 20 minutes away, that might not work because you can easily commute. Now, some people don't like commuting, but that's just the way that is. So that might be more challenging. But if you're in Sedona and relocating to Tucson, all day long. If you're in Phoenix and relocating to Flagstaff, all day long. So it really is a case by case, and we'll just have to make that adjustment and just kind of see with each individual. But for most part, it's a no. You have to pay one off to get the other one. It's very difficult to get through the relocating, especially nowadays when a lot of people work from home. Makes it a little bit more challenging.
Can we get FHA loans on people that are fixing and flipping properties?
No, so FHA flip rule is the only pain in the butt rule that I really think of. So I had that written down as one of the things to talk about, and I almost skipped over it. So thank you for reminding me. 90 days from the deed signing on the purchaser to the date of the new contract must pass 90 days. So if you buy a property and you're going to flip it, you have to wait 90 days before that deed is signed when you bought it to when you can go under contract for the new purchase. So that's an FHA flip rule. Conventional does not have that. So if it's a listing agent, one of the questions we ask is, okay, is it a flip? I'll look to see who owns it. If it's an LLC, I'll see when they actually transfer title. And then we look at that right away when we do an FHA loan. Because we don't want 2 to 3 weeks going down the road and feeling like, oh, this is a flip. So we do that immediately, figure out who the seller is, how long it's been in their name. You can't really get a loan on a property that's conventional FHA and then flip it. It's not really a tool for doing that. So I have a lot of strategies for people that are interested in flipping homes. My idea of the perfect strategy is get a home equity line as big as you possibly can and use that to flip, because it's like a paycheck. You write a check, pay yourself back. You write a check, you pay yourself back, and it can be used over and over and over again. But we can talk about different flip opportunities if you're interested in that. Let's see here. Any other questions regarding FHA or rates or refinances?
Yeah, I have another question. Can you get a FHA loan in an LLC or PLLC?
No. So here's the rule in LLCs and PLLCs. They are a limited liability corporation. What does a lender hate? Buyers with limited liability. So they're not going to be able to foreclose easily or start proceedings if the mortgage is in the name of an LLC or the title's in the name of an LLC. So if you ask a lender to do it in anything in the name of an LLC, they'll say pound sand. Now, you can do the loan in your name, and then whatever you do afterwards with title is your decision. A lender will never come after you for switching title into any entity unless you go late on that mortgage. They're not going to say, hey, you've been current on your mortgage. I see that you transfer your title. They don't have time for that. They're not going to transfer. They're not going to look at all the title transfers for every loan they service. So my advice, if you have an LLC created for each property, maybe it's a VRBO, whatever it might be, close it. The loan always has to be in a human's name, tied to a social security number. Close it, then change the title to your LLC post-closing. You can do that. Now, lenders don't like that, but you're able to do it. They won't call the loan doable and payable. They've never done that. All of my properties that I own, there's not a lot, but they're in individual LLCs for the address of that property. Let's see, any other questions? How far does each property need to be? There's no, LOL, perfect. All right, well, it's been about 30 minutes, so we don't want to go too long. If there's any questions, I'm going to stay on just to answer any questions that you guys may have. Oh, one more thing, FHA, you can refinance without any documentation too. So it's called Streamline. You can have no job and refinance an FHA into a lower rate. It's called a Streamline. So that's another benefit of FHA, but there's some pros and cons. Just make sure your lender and talks to the listing agent every time you make an offer with an FHA buyer. All
Hey,
right,
Sean,
guys.
I have a question.
Yes.
Do they allow like a co-signer or anything? I'm just thinking about my son. This is something he'd like to do, but his job history is not great. So
Yes. So FHA does allow a non-occupant co-borrower for any transaction.
for like a duplex type of thing is
Yeah.
what I'm thinking. Yeah.
Absolutely. Absolutely. Yep.
All right. Good. Thank you.
Yeah. Anytime.
Oh,
Any
states,
yes.
what states do you do business in?
Well, our company does every state except Georgia and New York. The way that the licensing works is I can do it in California, Arizona, Nevada personally, but anything outside of that, all I do is work with a loan officer from one of my other branches as the licensed loan officer for that loan file, and I will manage the whole file internally myself. So we can do it in any state. We just have one of our licensed loan officers for that state as the main licensee for that transaction.
Okay.
But everything
And
else
I'm-
is the same.
And can you tell me again what the loan limit is for a duplex? I'm sorry, I came in late.
No, it's okay. FHA is 471,100.
471. Okay, perfect. Thank you.
Yeah. And then conventional goes quite a bit higher, but then you also need a lot more money down. All right, guys. Again, I'll stay on, and you guys have an awesome week. I'll be on this for the next 10 to 15 minutes. So get after it, have fun. Know that I'm here if you have any questions, and I'll stick on for the next 10, 15 minutes.
Thanks. You're awesome. See you
You guys have a
next
great,
week.
yep. See you then.
Thanks, Sean.
Anytime.
Thank you.
My pleasure, Karen. Or is it Corinne? My bad.
I go by either. It is Corinne, but
Okay.
everybody
Okay, that's
says
what I
Karen.
thought.
You're one of the few people that notice that. Thanks so much.
Not a problem.
Thank you. Have a great week.
You got it. Have a great one. All right, guys, have a great day.